Hey everybody, it's Patrick here with the mortgage firm Tampa, and I'm here with Doug Wood today, my good buddy.
Hey Patrick, how you doing?
With the Wood team, Nancy and Doug Wood. They are amazing agents here in the Tampa Bay area, and me and Doug talk all the time about all kinds of real estate and mortgage stuff. And just recently, with the new tax bills coming out, we are in November, and tax bills, taxes are due by the end of November. Actually, that's not true. Taxes are due the end of, is it March?
End of March.
Taxes are due the end of March. Not everyone understands that. But if you pay your tax bill in the first month that it comes out and they get it by November 30th, then you receive a tax break of
Discount of 4%.
4%. So all mortgage companies will pay your tax bill by November so that you get that 4% tax break. So you don't have to pay your taxes in November, but it is smart that you do as you get a break on it. So me and Doug were talking the other day, and something popped up, and it has to do with something in the contract regarding prorations and when you purchase a home in the beginning of the year.
Right.
Okay? And what happens is when you go to closing, the title company only uses the tax bill that they have available, which is basically last year's tax
Typically
bill.
last year's tax bill.
And, but sometimes on that tax bill, something changed with ownership in the property. Possibly the taxes went up or the taxes went down. So when you go to closing, I guess in the contract, there is a clause that Doug's going to go over with us. And then when you go to the closing, you're going to sign off on what the proration of the taxes are, whether they're right or wrong. But there's a clause in the contract that Doug's going to talk about that may benefit you as a buyer, and quite frankly, as a seller, when the actual tax bill comes in and you can redo the prorations. So Doug, tell us where in the contract, a little bit more about this.
Sure, certainly. So here's the tax bill that people are receiving. Should be coming in the mail starting last week. So definitely open up and take a look at it and make sure that what you paid for taxes on your settlement statement this year matches up with what comes on the tax bill. Now, if it doesn't, if there's a large disparity in our contracts, it's actually Section K, it's prorations and credits. But there's a portion of the contract that says if there's a large disparity in the funds that were collected at closing from the buyer and provided to the seller, the disparity can be worked out between those two parties. So let's say when you purchased the home, the tax bill was $2,000 and you purchased it earlier in the year and the seller credited you $1,800. But your tax bill comes out in just now in November and the tax bill is $5,000, so a large difference. So you were paid $1,800 to pay the taxes for the year, but really you would owe another $2,000 because of the new tax bill. Because of that amount, the contract and the closing documents say that you can go back to the seller and ask them to make up the difference, pay you the difference. So it's all equitable and fair. That works for the buyer side, but it also works for the seller side, where if the seller paid over money in the transaction at the closing, they could then go to the buyer and ask. Now, we were talking about when does this most happen? It most happens when the home that someone's purchasing is not homestead exempted, meaning the taxes can go up at the level of the price of the property. So it's not capped as our homestead exemptions cap. So if you purchased early in the year from someone that was an investor or was not living in the property full time, so they've not homestead exempted the property, definitely check your tax bill and make sure that what you paid is reasonable to what was collected at closing.
Yeah, because the investor may have purchased a home that was homesteaded with really, really low taxes, but then because the investor purchased the home, they lost the homestead exemption on that property, and the only tax bill that was available at the time was last year's tax bill that was a homesteaded amount. And then now the new tax bill came out where it's not homesteaded, and those taxes went from $2,000 to $5,000, or it could even be more than that. I firsthand know of this. Many years ago, I owned a home as an investor, and I bought it, and then I turned around and I sold it later on within the same year or kind of in the same time frame. And it happened to me. The seller, the buyer of the property, came back to me that following November and said, "Hey, we based the taxes on, $2,000, and the taxes were $5,000. So we're respectfully asking you for the prorated difference. It's not the whole yearly amount.
Right.
It's only from like January to the January 31st, whenever I purchased the house, sold the home, and it was minimal. I think it was $300-400, but I paid the gentleman the money because it clearly states in the contract. Now, a lot of people.
Well, I was going to go with, that was for this year's taxes.
Yeah.
So for 2022. Now, if you bought a home last year in 2021 and you're getting this year's tax bill, in our area, because the price has appreciated so much, you're starting to see really large increases in your taxes more often than not. So what happens there?
So that is, we're getting more phone calls now. Now, I will say that when we close a loan, we look at all tax bills and the taxes that we're basing your monthly payment on. And those more than likely are going to be whatever is available at that time. So there are a lot of times that a home that someone is purchasing, the tax bill, because they're purchasing it from somebody who's lived in it for 20 years, and the tax bill is really, really low because of all the homestead exemptions over the years. So now you've got a house that is assessed at, let's say, $300,000. The new purchase price is $700,000 and $800,000. So the new tax bill that's coming out now is the tax bill that's based on the new purchase price, the new value of the area. It's just not that particular home. It's the value of the area. And so that $2,000 tax bill that we were basing your payments on, a new tax bill comes in at, $7,000-8,000. So payments are going to be going up a lot now. Now, what happens in that situation? So because the mortgage companies want to give the clients, the buyers, and pay the least amount of taxes, the mortgage company gets the tax bill in November, and they're going to pay the tax bill, period.
So they're going to pay it out of the funds that either they've collected over the year, or even advance you some money.
Correct. So if we only collected a tax bill of $2,000 and the tax bill comes in at $7,000 and you don't have that money in your account, the mortgage company is still going to pay that tax bill and get it paid by November 30th to get the discount. Now,
then what happens?
What happens is every single year when you own a home in January, you get what's called an escrow analysis. So every single year in January, you get an escrow analysis that analyzes your escrow account and to see if you have enough money in there or too much money in there, okay? And there's times when there is too much money, but most of the time there's not enough money in there. So in this situation in January, the mortgage company is going to send the borrower an escrow analysis, and they're going to say, hey, we have a problem. We collected for taxes at $2,000 a year, and the tax bill came in at $7,000. Okay, so we're short $5,000 basically. Okay, so the mortgage company at that point is going to ask the client, the borrower, we're going to give you a couple options.
Yeah, do I need to pay $5,000 in January?
So first option one is yes.
Okay.
Write a check for $5,000, bring that escrow current. Then the mortgage company is going to adjust the payment from the $2,000 to the $5,000.
Okay.
So you won't have another shortage next year.
Okay.
That's option one. Option two is a lot of people just don't have $5,000 laying around to write the check. okay? So the mortgage company will actually divide the shortage, the $5,000, into 12 monthly payments, interest-free, so free money, and then you can put that on top of your mortgage plus whatever the new amount is, okay? So your mortgage payment could go up hundreds and hundreds of dollars a month, but just for 12 months, and then it'll get to where it's supposed to be. So we get this phone call all the time. We 100% talk with every single client when we close their loan and let them know, here's what your tax bill is now, and here's what it's probably gonna be. Now, at that time, we're advising clients, if we think there's gonna be a large shortage, to go ahead and set up a bank account right now, just a separate account, and start putting $200-300 a month in it, so that when that escrow analysis comes back and you're really short, you already have the money sitting there, is what it is. So that's something that we do with every single client.
Right.
So,
and we also talk to our clients in advance, whether it's this year or in past years. This is what you're going to pay taxes now based on the settlement statement, but you really do need to plan for the future on this, so it's not a big shock. But if anybody has any questions, we are always open to talk to them about it, especially on the this year's 2022. If there's a prorated difference, we can help them work through that, and obviously talking to Pat and your lender and getting the information as well from them.
yeah, and then filing for homestead exemption, that's so important. We still have some clients that forget to file for homestead exemption, and your tax bill goes up a lot with that as well. So that's really, really important, and we all remind our clients. So Doug, thanks very much. I appreciate it. This is like valuable stuff, okay? Because you can get some money coming back to you, or you may owe a little bit of money to the person who you bought the house from. So thanks very much for coming in.
Great, thank you.
Thank you.